good evening.
Hi.
Some familiar names. So thank you for coming and signing on at 6:30 in the evening. My name is Beth Underhill. I'm the Financial Literacy Program Leader for Falmouth VIPS. And although we've been, bringing financial education, as some of you may know, into the schools for several years, we've always had something we wanted to do for the faculty. So finally, here we are able to do it. So before I actually introduce our guest speaker, Susan Roman, I do want to commend you for coming, because I've worked in personal finance all my life, and many of which have been years crafting financial education workshops like this for employees of companies across the country, whether it's biomedical engineers, financial professionals, believe it or not, at banks, as well as truck drivers, wherever you are on the spectrum. There's always a thirst for this information, because it's such a vast universe of products, services, just knowledge, and everyone's confidence levels at different places with it all. And I think Susan and I can attest to that. It is a full-time job, literally, just to keep up with it all. So good for you taking this opportunity, because I feel like people come to these maybe just to reinforce something they have an instinct about or know something about. So it's like good to get it validated, especially from a professional like we have here tonight with Susan, or hopefully to grab little tidbits of new information, something you maybe need to think about, especially with the important topic of retirement. So without much further ado, let me just do the housekeeping, and then we're on to Susan. This session is being recorded. You're welcome to keep your video on or off, whatever you prefer. We'll use the chat box during the presentation to put in a question as it comes up. Feel free to do it. Susan's going to pause at times to ask for questions, but I'll be the one to moderate that, just because she can't actually see the chat box when she's presenting. So as you probably tell your students, there's no dumb question. So please, this is really such a great opportunity to get access or answers to those questions you may have. And then at the end, she'll stick around for questions that might have come up. And again, so feel free at that point, use the chat box, or because if there's a few of us, everyone can unmute themselves and we can have a conversation. And then just a little disclaimer, this is meant for financial education purposes only, and should not be construed as financial, legal, or tax advice, because we simply can't capture every nuance there is when it comes to retirement plans and programs. But hopefully, again, you just have some grasp from basic key concepts and issues when it comes to retirement. So without further ado, let me introduce Susan Roman, whose name may be familiar, because she is the parent of 4 Falmouth Public School kids or students. One has graduated, one is about to graduate, and 2 more coming up to the high school. So her name may be familiar to you. And she's so clearly been involved in the schools for many years in various capacities. She now sits on the board of advisors for VIPS. So I was very glad to be able to reach out to her to come and present these slides that we developed internally at Falmouth VIPS, and she can just be the credible source of information to give this to you. So without much further ado, Susan, when I hand it over to you, and if you could just give them a little bit more information on your background, that'd be great.
Sure, I'd be happy to. Hi, everyone. It's nice to be here. Thank you for Beth. Thank you for putting this together and for having me tonight. And welcome to everyone who is joining us this evening. As Beth mentioned, we have 4 kids, 3 of whom are still in the Falmouth Public Schools. So I can't see everyone's names right now, but hopefully I did see a couple who I recognize. So I'm glad you're here with us tonight. Additionally, I actually went to Falmouth Public Schools through 6th grade, so I might know some of you that way too. After I went to high school, I went on to college and law school, and then after law school, I ended up working at PricewaterhouseCoopers in the multi-state corporate tax team. I did that for a few years in both their Boston office and Philadelphia office. And then, my husband and I ended up moving back to Falmouth, where I grew up, when we had our first child. So at that point, I stopped working at PricewaterhouseCoopers, and I was working for a lawyer one day a week and staying home with the kids the rest of the week. My husband always jokes and says that I always had the biggest smile on my face on Wednesday mornings. But anyway, after doing that for a number of years, I ended up getting back into the financial world and became an investment advisor about 7.5 years ago. And then I earned my marks as a certified financial planner last year. I did open up my own firm about 2.5 years ago now. And as you can tell, probably from the name of my office, Women Retirement Planning, I strongly believe that it is important for everyone to think about planning for their retirement. Whether that's 30 years away or 3 years away, it's something that everyone should think about. So like Beth said, I commend you all for being here tonight. I think it's great that you are taking the time to do this. And hopefully you can learn a few things. So with that being said, why don't we get started? And I apologize if I make you dizzy with my clicking. Sometimes I lose I lose control of it, but let's see. Hopefully it'll go fine. Okay, so this first slide just provides an overview of different sources of retirement income. Not everyone will have all of these sources of income, but usually there's some combination. And when you look at this pie graph, I just want you to think about the fact that some sources of income are guaranteed and some are not. So, when you think about it, if you are eligible for Social Security or a pension payment, then that income stream is guaranteed for your life. There are other sources of supplemental retirement income that you may have access to through either an employer sponsored plan like a 403B or a 457 or a 401k, or through an individual retirement account. But those sources of income are not guaranteed necessarily. Also, the amount of income that you can draw from those supplemental sources will vary depending on how much you have saved over the years into them and how you've invested them and how they've grown over time. So let's move, let me see, with that in mind, let's just talk a little bit about saving and investing to build those sources of retirement income. So there are certain rules of thumb that you can follow to help you. One of them, the first one being that it's great if you can save 15 to 20% of your income consistently for retirement. And generally speaking, that's in addition to what you're paying into the pension plan. I know that sounds oftentimes like a lot, and it's not always easy to do. It's easy to say, not always easy to do. But as many of you know, and especially you math teachers, the earlier you start, the better you'll be due to the value of compounding interest. And the reason why you want to save above and beyond what you're paying into the pension is because, as I'm sure many of you understand, when you're entitled to either a pension or Social Security benefit, you may get cost of living adjustments, but first of all, they're not guaranteed every year, and secondly, they're often very, very minimal. So, if you are collecting either Social Security or a pension and your income is barely going up year over year, then you're most likely not keeping up with the increasing costs of expenses that you're going to face in retirement, like healthcare, long-term care, housing expenses. So it's always nice to have those supplemental sources of income to cover any additional expenses whereas those fixed income payments don't necessarily cut it all the time. Again, like I said in the last slide, when you are saving into those retirement savings plans, either through your employer or through an IRA, they can supplement your Social Security, your pension benefits by having the potential for growth in your overall retirement savings. But a lot of that has to do with how you are investing. And so we are going to investing those funds. So we're going to talk about that a little bit later as we move forward. But just remember, you always want to try to match your time horizon and your risk tolerance in order to help you choose your investments in those other accounts. Okay, so let's talk now about some of those guaranteed sources of retirement income. If you're a full-time employee of the Falmouth Public School System, you are paying into one of two pension systems, either the Massachusetts Teachers Retirement System, or the Town of Falmouth retirement system. And I can hear again, I'm sorry for the crazy clicking, but here we go. So for either one, they're very similar. And for either one, your eligibility to receive a retirement allowance or pension is based on your membership date, your years of creditable service, and the age you are when you retire. How much you can receive will depend primarily on your earnings and your years of service. But you will also be given choices once you decide to, once you are choosing, you'll be given choices for your pension payment. I think there are 3 right now, and how much you will receive will depend on whether or not you are deciding to have anybody else receive anything after you pass away. So it's a good idea to really start to get familiar with those choices ahead of time. And one great place to start is right on the MTRS website, if that's the pension system that you're paying into. It's a comprehensive website that provides a lot of really, really good information. It answers a lot of questions in language that's pretty easy to understand. So I definitely would encourage you to go to that website and to really read as much as you can. And if, on the other hand, it is, let's see here. Sorry, if you're paying into the Town of Falmouth retirement system, then this is the website that you would want to visit. And it also has a lot of really good information. It's a comprehensive website. So I definitely would encourage you to really look at both of those or one of those. And if you aren't sure which system you're paying into, by all means, you should call the Human Resources Department and ask them. Okay, let's see. I lost my there we go.
Susan, I'm just gonna, I guess if anyone has any questions,
yeah,
feel free to use the chat box. I thought you made a good point. It might have been in a side conversation we had, especially because given the pension options that you have, I think they're called A, B, and C, at least under the NPRS, I should say.
Yeah.
How you got to really investigate it for yourself, because sometimes you get caught up in conversations, what other people are doing, or you feel it out in those sort of informal ways. I don't know, as a planner yourself, do you find that with clients?
Yeah, absolutely. A lot of times people will be talking to their friends or their colleagues or their coworkers and make preliminary decisions based on what everyone else is doing. And as I'm sure you can imagine, that's not necessarily the best way to make a decision. It's really very specific to your individual circumstances. So and we'll talk a little bit more about things that you want to consider as you're contemplating all these decisions, as you're getting closer to retirement. But it definitely is a very individual decision for everyone.
And then just to echo, I was on that website as well. I was pretty impressed with the amount of information and tools that are available, just to even get you familiar with the terminology, because sometimes you got to really digest it over a period of time.
Yeah, absolutely. I heard once, and I think it's true, you have to hear things, or either read things or hear things at least 3 times before that really sinks in. So, okay, so the next source of guaranteed income that we can talk about is that Social Security. So, as many of you know, people are entitled to Social Security if they have a certain number of qualifying quarters. It's 40 quarters. So if you have been paying into the Social Security system for the requisite number of quarters, then you are entitled to a Social Security benefit. There are a few phrases or terms that you should get comfortable with, one of them being the full retirement age. So your full retirement age is the age at which you are entitled to your full retirement benefit, your full Social Security retirement benefit, which is also called your primary insurance amount. So if your full retirement age depends upon your year of birth. So if you wait until your full retirement age to collect Social Security, then you will be entitled to the full retirement benefit. Right now, the latest full retirement age is age 67. I believe it's for people who are born either 1960 or after. However, if you have enough qualifying quarters and creditable covered employment, then you can collect Social Security as early as age 62. But if you do that, then the amount that you will collect will be reduced. By the same token, if you wait beyond your full retirement age, anytime up until age 70, then you will earn delayed credits on that retirement benefit. And so you will actually get more than what your primary insurance amount is. So now you may be thinking, well, that's not necessarily the case for you guys. If you're paying into the pension system, then those years are not considered covered employment. And so, you may be thinking that you don't have social security benefit, but you may actually still have one if you have years of employment prior to working for the town or becoming a teacher, or also, you may be entitled to a spousal benefit through your spouse or ex-spouse's work record. So you definitely I definitely would encourage you to get onto the Social Security Administration website. They used to actually send out statements every single year to people to show you what your earnings record are and what those estimated benefits will be, but they don't do that anymore. They stopped doing that as a cost containment measure. But you can log on to the Social Security Administration website and you can look and see, what your full retirement age benefit is projected to be, what it would be at age 62, what it would be at age 70. And remember, they're basing it on years of covered employment and your earnings during those years. So you'll also be able to see your earnings record. And that's something you want to look and just kind of check and make sure they have accurate information for. Another thing just to keep in mind, obviously, I'm sure you are all somewhat familiar with this, is that if you are entitled to a Social Security benefit, but you have been paying into the pension system, then you may be subject to one or both of the offset provisions. So the windfall elimination provision may reduce your benefit if it's based on your own work record, whereas the government pension offset will reduce your benefit potentially if it's based on your spouse's work record. So just keep that in mind as you're looking at the Social Security information, is that they're saying what it will be as though you didn't have an offset, but then those two provisions may actually reduce your Social Security benefit. And another thing, back to what Beth was brought up in the last slide, and something to consider, is oftentimes people will, there are a number of different claiming strategies. And a lot of times people will assume, oh, it's best just to wait to collect Social Security as long as you possibly can, because as I mentioned, the longer you wait, the higher that benefit will be. However, that's not always the case. And especially if you are in a situation where your Social Security benefit may be significantly reduced by one of those offsets, well, it might make sense for you to start collecting earlier rather than later if you're not yet collecting your pension. So, and it's something that you just have to look into yourself. There's no, one size fits all for everyone. And that's where it's really important to get in there and to get onto the website and to start getting a feel for what those projections are and figure out how those offset provisions might affect you. I should stop. Does anybody have any questions right now, Beth? I don't know.
Questions, but I will. This is where I assign homework. I love assigning homework to teachers. And that is that top yellow box: establish your account and access your information. Your information is out there, right? You're just going to go claim it as yours by setting up your username and password. And then that gets you access to your earnings record to look at, and you'll see your Medicare earnings, because so you just, like Susan said, go and review all that information. It's another vast area of information you start to get familiar with now. Make sure your earnings are correct and all of that, and see those gaps when you weren't paying in, which is obviously potentially when you were paying into the municipal pension. Okay. Yep, we're good to move on.
Okay. So now let's start talking about those sources of supplemental sources of retirement income. So first, we'll cover the retirement savings plans that are available to you as employees of Falmouth Public Schools. You are, as an employee, you're eligible to contribute to a 403B plan, which has a choice of providers. And I'll go through sort of the rules and tax treatment of each of these. So with the 403B plan, you can make pre-tax contributions, meaning that in the year that you make the contribution, that amount of money is not subject to tax. Those earnings grow tax deferred. And then down the road, when you take the money out of the 403B, both your contributions and your earnings will be taxable. There are rules surrounding both the contributions that you can make and the distributions that you can take. So first of all, in 2021, you are allowed to contribute up to $19,500 annually. But if you are age 50 or older by the end of the year, then you can contribute an additional $6,500 a year. There's also a special catch-up provision that allows you to make an additional contribution if you have 15 or more full years of employment. So if you think that might apply to you, then you should definitely check out the plan website for details. With respect to the distributions, you can take a distribution from the 403B without any kind of penalty if you separate from service when you are age 55 or older. On the other hand, if you are not separated from service and you take a distribution prior to age 59 and a half, then the distribution you take, in addition to it being subject to ordinary income tax, but the distribution you take will also be subject to a 10% penalty. So that's something that you want to be aware of. And there are some limited exceptions to that penalty. The other thing to keep in mind is that once you turn age 72, you will be required to start taking distributions from the 403B plan. And I think a lot of times these rules get confusing, but if you think of it sort of overall, you think, okay, the government knows that, most likely Social Security or your pension isn't going to cover all of your expenses in retirement. So they offer these tax advantage plans to try to encourage people to save additional amounts to supplement their retirement income. So in order to incentivize people, they are saying, we're going to give you tax-free. We're going to let everything grow tax deferred so that you're saving for retirement. So if you start taking that money out too early, well, then you're not really saving it for retirement. So that's why they will penalize you. On the other hand, if you're age 72, the assumption is you're probably retired or you're using that money in retirement, and Uncle Sam wants his tax money. So they make you start taking it out. Okay, so now the 457B plan, which is also referred to as the Massachusetts Smart Plan, has two different options for contributions. One is a pre-tax contribution, which is very similar to which is the same as the 403B plan, in that you make contributions that are not subject to tax in the year you make the contribution. Then there is also an option to contribute to the Roth portion of the plan, which for any contributions you make to the Roth portion are all after tax. In other words, it's not a salary deferral on that piece of it. The earnings all grow tax deferred. And then as far as the contributions to the pre-tax portion of the plan, when you take the money out of that portion, everything will be taxable, both the contributions and the earnings. On the other hand, when you take money out of the Roth portion, everything will be tax-free, provided that you meet these qualifications. In other words, you have to have made your first contribution to the Roth portion at least 5 years prior. So if you follow the rules and you made those qualification requirements, then the Roth money comes out tax-free, which is a nice thing to have. Again, like with the 403B plan, there are rules regarding both the contributions and the distributions. With the contributions, you're entitled to contribute up to $19,500 with an additional $6,500 a year if you're 50 or over by the end of the year. And then there's this additional special catch-up that allows you to contribute an additional $39,000 if you are within 3 years of normal retirement age. So again, if you think that might apply to you and you want to do that, definitely visit the plan website. With respect to the distributions, this is the distribution rules on the SMART plan are slightly different from the 403B, in that distributions are allowed at any age upon separation of service. You don't have to be 55 or older. In other words, I should say the distributions are allowed without any kind of penalty upon any age of separation of service. If you are not separated from service, then you need to wait until you're 59 and a half. Unless you meet, one of the limited exceptions. Otherwise, you will pay the 10% penalty. And again, there are required minimum distributions that must begin at age 72. Another thing that's definitely you want to remember here is that you are eligible as employees of the Falmouth Public Schools to contribute to both of these. So, if together you and your spouse have very high income, this is a great way to get that taxable income down, you know, by making these pre-tax contributions. It's also a great way, you know, to contribute to a Roth, to build Roth money, tax-free money in retirement, because, and we'll talk about it in a minute, but contributing to a normal Roth IRA has income restrictions on it. And then it's just a great way to supercharge your retirement savings. So, so it's nice that you have both of these options. And Beth included links to the IRS if you want to look a little bit more at those rules. Does anybody have any questions about any of that?
I don't see any questions. Do you have any insights into why someone might choose a 403B versus 457?
Well, you know, it depends, first of all, on a number of things. You know, with the 457, like I said, you do have the ability to contribute to a Roth portion of the plan. So that might be important to you. You know, you may be more interested in building a pot of money that has tax-free money that you can take out in retirement. You can also look to see the different investment options that are available in each one, the choice of providers. So, you know, I think it's important to just look at each of the websites and make that decision. And like I said, you can certainly contribute to both if there isn't a strong reason to do one or the other.
Good. Thank you.
All right, let's see. So now, let me see here. So this is just the website, you know, if you are wanting to learn more about the pension plans or the 457 plan or the 403B plan, if you go to the Falmouth Public Schools website, you can click on retirement information, and then it will bring you to this page where there are hyperlinks to the both of the pension websites. If you're a part-time employee, you can look at the Nationwide website. You can look at the SMART plan, and this is the 403B plan. So again, as I've been saying all along, I encourage you to really look at those websites and get as much information as you can.
And just to add a point to the 403Bs, if you may be familiar with it or not, that's going to be a list of providers. So that's typical for school districts. They give you, you know, maybe 10 to 15 providers that offer 403B plans. So again, it kind of gets to, it's just maybe looking at the investments, or maybe you have an account with one of these providers already. This is a way to kind of keep all your stuff in one place. So just so you're aware when you click on that, that's what you do. Unlike the 457, which is just one plan.
Yep. Yep. Okay, so now on this side, we're going to talk about other sources of supplemental retirement income. Can include both Roth IRA or traditional IRA. So with the Roth IRA, like it is with the 457B Roth option, you are making contributions with after-tax dollars. In other words, you don't get any kind of salary deferral or tax deduction for the amount of money that you're contributing in the year you contribute it. The earnings will grow tax deferred. And then when you take the money out, everything comes out tax free, provided you meet that 5-year rule. There are, again, rules surrounding both the contributions and the distributions. The biggest one in my mind being that not everyone will be eligible to contribute to a Roth IRA, depending on your adjusted gross income. So if you're single or head of household and you make less than $125,000, your adjusted gross income is less than $125,000, then you're eligible to make a contribution to a Roth IRA. If it's more than $140,000, you can't make anything. You can't contribute at all to a Roth IRA. If it's somewhere in between, then you can make a reduced contribution. And the same concept holds true for married filing jointly with these numbers. So it's tough because it's really nice to have a pot of money, a pot of retirement money that is tax-free, but not everyone can make those contributions. And the reason why it is nice to think about having you might have tax deferred accounts where you're taking the money out, and when you take it out, it's taxable, versus a Roth IRA, which is tax-free money. Is, oftentimes when you think about in retirement, you've got your fixed income payments, your pension payment, or your Social Security, And you might, on occasion need to take a big chunk of money out of a supplemental source of retirement savings for something like, let's say you need a new roof, or you have an unexpected health event, or there's some other reason why you need to take a significant amount of money out all in one year. Well, if you take it all out of a tax deferred account, meaning an account that's going to, the distribution will be taxable in the year you take it, you may know that it's subject to ordinary income tax, but what people often don't think about is that by having a big chunk of income on your 1040, not only will it increase your income tax, but by increasing your adjusted gross income, you may also end up with a higher Medicare premium, or your Social Security benefit more of your Social Security benefit may be subject to tax. So there are other unintended consequences sometimes of taking money out of a tax deferred account. So it's nice to have a pot of money that's also available that will come out tax-free. All right, so now let's talk about traditional IRAs. So with a traditional IRA, so let me explain this, kind of give you the overview first. Anyone can contribute to a traditional IRA. Whether or not you can also take a deduction for that contribution will depend on two things: whether or not you are a participant in an employer-sponsored plan, and if you are, what your adjusted gross income is. So you if you're paying to a pension system, then you are considered a participant in an employer-sponsored plan. So your ability to deduct any kind of contribution to a traditional IRA will depend on your adjusted gross income. So if you're making contributions that are after tax, in other words, that you cannot take a deduction for, all earnings are tax deferred. And then when you, those after-tax contributions will come out tax-free, and then any deductible contributions. So in other words, if you are eligible to take a deduction, then the contributions you make that you've taken a deduction for will be taxable when you take them out. And then all earnings are taxable. Once again, there are rules with respect to contributions and distributions. So right here, and I'm sorry, I didn't even mention with the Roth IRA, you can always take your contributions out without being subject to any kind of income tax or penalties. But like with the 403B plan and the other plans, if you take a distribution of earnings, not the contributions, but earnings prior to age 59 and a half, then you may be subject to a 10% penalty unless you fall within one of the limited exceptions to that rule. One thing to mention that's interesting about a Roth IRA is that there are no required minimum distributions, which is another nice reason to have some money in a Roth IRA. You're not forced to take money out of it every year. With the traditional IRA, if you are contributing with after-tax dollars, then the distributions are treated as pro rata across both contributions and earnings. Again, any distributions before age 59 and a half are subject to that 10% penalty unless you fall within one of the limited exceptions. And then, unfortunately, there are RMDs for traditional IRAs. So you are going to be required to take a certain amount of money out every year after you turn 72. And just so you are familiar with it, what the RMD, the amount that you're required to take out every year once you turn 72 is based on the prior year-end balance and the age that you are. And just so you know, the maximum contribution that you can make every year, or I should say for 2021 at least, is $6,000 plus an additional $1,000 if you are 50 or older. And that is a total maximum. So you cannot, it's not $6,000 to a Roth and $6,000 to a traditional. It's in total, you can contribute $6,000 or $7,000 if you're over 50. All right, does anybody have any questions about that? Any of that?
Nothing in the chat box, but.
Okay, all right, well, keep going. All right, so let's talk a little bit now about, excuse me, choosing your investments. So whether you're saving money in those employer-sponsored plans or you're contributing to a Roth IRA or a traditional IRA, there are certain things that you want to think about when you're choosing your investments. So the two big questions really are, what is your time horizon? In other words, when are you going to need to draw from those accounts? And what is your risk tolerance? You can kind of ask yourself how well you slept during last March, the volatility last March. And so when I talk to my clients, I try to, if you kind of think about it in the sense that you have a financial life cycle, there are really two main, there are two different phases of your financial life cycle: the accumulation phase and then the distribution phase. So in the accumulation phase, you're just socking money away. You're trying to, save when you can. You're busy, you're working, you have responsibilities to your employer, to your students, to your family. And you're not thinking too much about what's happening in the markets on a day-to-day basis. You're just thinking, all right, I don't need to worry about it because I've got years before I need to even touch that money. On the other hand, as you approach the distribution phase, that's the distribution phase is when you're going to have to potentially start drawing on those savings. And as everyone gets closer to their distribution phase, most people start thinking a little bit more about the volatility. They're going to listen a little bit more closely when the news is talking about the S&P 500 or the Dow or what's been happening in the markets, because all of a sudden it becomes, it becomes clear that if you are going to be drawing from that in the near future, there's going to be a point where you're not comfortable with a certain amount of volatility. And it's really a good idea to have an understanding of what your comfort level is. And the reason is because if you don't have that understanding, and if you're in a strategy that is too risky and, something that's outside of your comfort zone, that's when you're more likely to make more of an emotional decision rather than one that's based on any kind of strategy or plan. And you can think about it like if you can people who have seen their accounts go down and down and down and down, and at the worst possible time they'll say, that's it, I can't handle it anymore, I want to get out, I want to sell everything, and they go to cash. And then as the markets start to come back, they're still sitting out because they're gun shy, they're nervous. They say, I don't want this to happen again. And people start talking about, oh, my account's doing well. The news is saying the markets are doing well. And then eventually they'll say, okay, I'm comfortable now, I'm going to get back in. So they end up selling at the bottom and then getting back in after they've missed a good chunk of the uptick. And so when people do that, it's really based on emotion. And, when they're following that kind of behavior, that's sort of a recipe for disaster, right? So the idea is that you want to make sure you're in a strategy that you understand and that you're comfortable with, so that you are not making those decisions based on emotions. Okay, so one thing that you can do to help you figure out sort of what that comfort level is to complete an investor profile. A lot of times at your financial institution's website, you can do that. Another thing that you want to think about when you're choosing investments is that you want to be diversified. And that can help mitigate risk. And again, when you listen to the news and they're talking only about the S&P 500 or the Dow, a lot of people think that's all there is to the markets, but there's so much more. And you want to make sure that you're not just, allocated appropriately between stocks and bonds, but within each asset class as well. So, you might have large cap growth, large cap value, small cap growth, mid cap value, international. You just want to make sure that you are well diversified. And there are different approaches to doing that. So one would be for you to choose your mix of investments. And another thing I should say is it's always a good idea to have at least 6 months of living expenses, about 6 months, maybe 6 to 12 of living expenses in cash or cash equivalent, so that if there is an emergency, you have the cash right there. You don't have to liquidate something at an inopportune time. But beyond that, you're going to choose the amount that you want in bond funds and the amount that you want in stock funds. Another approach would be to choose sort of an all-in-one strategy, either with an asset allocation fund or a target date fund. So with an asset allocation fund, those are ones that are defined by, a static asset allocation. So you might have a fund that has 60% in equities at all times and 40% in fixed income, and it stays that way. Alternatively, if you choose a target date fund, you are choosing a fund that the target date is closely aligned to the date when you think you might retire. And so as you get closer to that target date, the mix of assets within the fund will change and will become more conservative. And so you don't really have to do anything yourself. It's done for you. So those are generally some different approaches. Does anyone have any questions about any of that?
No, we're good.
Okay. All right. So then, whoops, I lost my little thing. Here we go. Excuse me. Okay, so there are some other things just to consider as you get closer to retirement. I encourage everyone who I work with to start tracking their expenses just to get an idea of what you're going to need in retirement. It's not always an easy task, but you can get a general idea. And you want to think not only about what you're spending now, but how things might change when you do retire. And, think about the lifestyle you want to lead. Do you want to visit your grandchildren, go on a trip every year to visit your grandchildren, or join a tennis club, whatever it is, you want to make sure you account for the lifestyle you want to lead. You want to understand all of your sources of income and how they're taxed at both the federal and state levels. As I mentioned before, you want to look to see whether or not you are entitled to a Social Security benefit, whether it's based on your own work record or your spouse's. You can go on the website, and also you can certainly call the local office, which is in the Falmouth Technology Park, make an appointment to talk to them about your situation. Another thing, 4 and 5 kind of relates to number 1, is that you want to make sure that you understand Medicare. Most people are going to be eligible for Medicare. If you've paid at least 10 years into Medicare, you'll be eligible, or if you're married to someone who has. But Medicare is not available until you're age 65. So like right now you're paying, you get healthcare through your employer. And once you retire, the healthcare through your employer will be supplemental to the Medicare coverage that you will hopefully have. But if you retire before age 65, when you're eligible for Medicare, you've got to ask, what are your options? How much will your healthcare cost increase? What does it cover? Who does it cover? What happens if you die before you're eligible for Medicare? Those are all questions that you want to ask, because that will, in my experience, I think healthcare is what has the biggest impact on people's expenses in retirement. So that being said, I know this is a lot. We've gone over a lot in a short amount of time, but there certainly are resources here that can help you find professional guidance, either at your own financial institution. If you're looking for a certified financial planner, this is the website that you would go to. There is a resource for fee-only financial advisors. If you want to check out your financial professional's background, if you're working with a broker, you'd want to go to broker check at FINRA. Or if you're working with an investment advisor, you go to the SEC website. So those are all good resources for helping, find some professional guidance. But, whether or not you're doing it on your own or you're working with someone, again, I think the most important thing is to understand your current financial situation. And by the fact that you're on this, I think that's great that you're taking those steps to understand everything. And then just to get an idea of what you want in retirement and put together sort of a roadmap to get there. So does anybody have any questions about anything? Because that's all, I think that's all we have for now, unless there are questions.
Certainly a lot to digest. I guess I have one for you, Susan. I was just thinking of this. The first step there about start tracking expenses, because it's seemingly so straightforward, but isn't that really the root of how much you're going to need in retirement? People always want to know, what's the number? What's the magic number I need to retire? So if you want to expand on how you explain that to even your own clients and the importance.
Yeah, well, like you just said, a lot of times people will come with that question, like, how much do I need to retire? And there's no one easy answer. It's not, there's no one answer that applies to everyone. It really does depend on, what your expenses will be and what you see as your lifestyle, and what your sources of income will be, your guaranteed sources of income. And so, we always try to figure out, okay, if you've got a certain amount of guaranteed income and we know what your expenses will be, we can sort of project, what you would need to save to have a safe withdrawal from your supplemental sources of income to cover your expenses. But it really is it's such an individual analysis for everyone. There are some people who, really, once they retire, they just want to stay at home, read a good book and not not do too much. There are others who want to travel and spend a lot of money. So it really, it's an individual and analysis that everyone has to sort of go through themselves to figure that out.
And maybe it's appropriate time to plug, we're going to be doing a community workshop, one that's open to all Falmouth community about ABCs of personal finance. And the first part of that, just to give you guys a little sneak peek, is really this concept of you got to start looking at your numbers. You got to, track those expenses now, and giving you those resources or apps and ways to do that. It's painstaking. It's kind of fearful sometimes of knowing where your money's going, but it's really where you have to start now, so that as you get closer to retirement, it's going to be a lot easier to do those projections.
Right.
And if you start doing that now, like you can start, maybe you have to hype up your savings to the point, depending on what you think you want to do in retirement.
And I will say, no matter what, when I, in my experience, people come in very nervous about the whole process and, sometimes overwhelmed, but without fail, once you get going and you start figuring it out, no matter what the projections look like or what we figure out, just by doing it, people feel better. There's a little bit of okay, I can breathe because you're figuring it out. It's the fear of the unknown. I think that's so difficult for people. So I don't know. That's how I feel. I think it's so important to do it, and I think that people are generally very happy once they do, even though it's work. It's a good thing to do, and you feel better after having done it.
Yep, very good point. So we don't have any more questions, at least in the chat box, but this is the end of the slide. So if anyone wants to unmute and ask a question, feel free. Just a couple of things as we wind up. We have recorded this, as I said, and we plan to post this along with the PDF of these slides that have all these great hyperlinks, so you can start doing your homework. That will be on the VIPS website, probably maybe early to mid next week. So that was one thing. We have resources on each slide. That's always important. I feel like we, obviously can only cover so much, but we try to at least give these resources that are comprehensive and, come in digestible sort of chunks. And I guess that's it. So if anyone.
Thank you everyone for coming today.
Mary Beth?
Yeah, I just wanted to say thank you to the VIPS for hosting this, and also a bit nice thank you also to Susan, who's so nice, and her kids are great. Always nice to see you, and thank you for being. It was very informative, and I really do appreciate it.
Thank you.
And congratulations, Susan, on your new business. That's great.
Oh, thank you. Yeah, thank you very much.
Thank
I'm
you.
glad you could come. It was nice
so
seeing
much.
you. All right, it was nice seeing you.
Yeah.
Nice to see you guys.
And Deanne. All right, take care, everybody.
Yeah.
Bye, everyone.
Thank
Okay,
you.
Thank you.
Thanks.
Oh, nice. Oh,
So-
well, I look very blurry and all that now.
Why? Yeah, you look darker than before.
I could stop the recording, I think, right? Oh, no. Oh, maybe I can't.